In the past, finding good stocks have always felt daunting to me. No matter how I look, I was either too late as the stock had already skyrocketed, or I was looking in the wrong place and was chasing hype that eventually crashed. I always thought that I had to find that one hidden gem, and it was nowhere to be found. But over time, I realized that I was actually overcomplicating things. Finding good stocks isn't about chasing trends, but rather it's about understanding fundamentals and valuations. Now, I know that might sound complicated to many of you. I've also felt that way, but trust me, it's actually much simpler than you would think. That's why in this video, I wanted to share 5 companies that I believe are great investments. And more importantly, through these examples, you can understand what to look out for when researching stocks yourself. And with that being said, let's jump right in. The first stock that I have in this list is S&P Global. If you are thinking, the name sounds familiar? Yes, it's the same company that created the popular S&P 500 index. However, that is actually just one part of its business. S&P Global is a financial powerhouse that provides critical data, analytics, and credit ratings that help investors, businesses, and even governments make informed decisions. Their biggest business segment is the S&P Global Market Intelligence, which offers all kinds of financial and industry-specific data that you can think of, such as markets-related data, company data, as well as economic trends. For example, if you have ever used Yahoo Finance before, some of the data here is actually provided by S&P Global. Then they have another segment called Commodity Insights, which also provides data but focuses on the commodity sector. So think of energy, metals, agriculture, petrochemicals. This is followed by the Mobility segment, which delivers automotive and transportation analytics, helping companies understand vehicle sales, supply chains, and future mobility trends. S&P Global is also one of the largest credit rating agencies in the world. Together with Moody's and Fitch Ratings, they control around 95% of the credit ratings in the financial market, where they provide independent assessment of the creditworthiness of companies, governments, and financial instruments. Then, of course, there's the Indices division. Here, they create and maintain some of the world's most recognized financial benchmarks, such as the S&P 500. Not just that, they also have many other indices that track many different things, such as commodities, dividends, global broad market, sectors, and so on. And whenever fund managers like Vanguard and BlackRock create ETFs that track these indices, they'll have to pay S&P Global a recurring licensing fee. Now, one of the things that make S&P Global such a strong business is its recurring revenue model. For example, 96% of their market intelligence revenue is on a recurring basis. Commodity Insights, 89%, Global Mobility, 81%, and the Dow Jones Indices, 84%. This provides the company with highly predictable cash flow, making the business resilient across economic cycles. S&P Global is also an extremely profitable business with a high gross margin of 69%. And since most of its services are data-driven, the company has low capital expenditures, which allows it to convert a large portion of its earnings into free cash flow. They are also in a unique position where all of their divisions benefit from long-term secular growth trends. For example, with the world becoming more and more data-driven, the need for real-time financial intelligence to make better decisions will rise as well. And as passive investing becomes a more and more popular investment strategy, S&P Global will benefit from the ever-increasing assets under management in index-based funds. And as the global debt levels continue to rise, companies, governments, and financial institutions will always need credit ratings to issue bonds and secure financing. But perhaps what's even more impressive about the company is that not many companies can do what S&P Global does. Its brand, reputation, and decades of proprietary data has created high barriers of entry, giving it a wide moat that protects its dominance for years to come. With all these reasons, it shouldn't come as a surprise that S&P Global is trading at a premium now. According to Morningstar, S&P Global's fair value is around $480, which makes it overvalued by around 12%. Speaking of Morningstar, Momo lets you check out premium Morningstar's independent stock analysis and fair value estimates for free. That's not all. Momo also offers a variety of stock price and analysis tools. For example, if you are wondering whether your stocks are overpriced, you can assess this by comparing companies' valuation. This information is available on Momo, which helps you determine if the valuation is high relative to historical levels. This allows you to understand whether the company's stock price is currently overvalued or undervalued. Besides that, You can also check out Wall Street professional insights on Momo, including buy and sell ratings for each stock, along with their specific target prices. Furthermore, Momo also provides information on the historical accuracy of each analyst, assisting you in making more informed investment decisions. Momo also offers many stock price analysis tools that you can try out, such as tools for analyzing support and resistance levels to identify potential buying and selling points, as well as tools for assessing market sentiments. New users who sign up to Momo Singapore now will get to earn up to $2,266 worth of welcome rewards when you fulfill the terms and conditions, as well as enjoy zero commission for US, Hong Kong, and Singapore stock trading and zero commission trades on US options every month for up to 100 contracts. Next up, we have CrowdStrike. CrowdStrike is a leading cybersecurity company known for its cloud platform that protects organizations from various cyber threats. And no, CrowdStrike is not just an antivirus company. Unlike traditional antivirus software, CrowdStrike goes beyond just detecting known threats. It proactively prevents, detects, and responds to cyber attacks in real time using advanced AI and machine learning. As of 2023, CrowdStrike was used in 44 of the Fortune 100 companies, 37 of the top 100 global companies, and 9 of the top 20 major banks. This makes them the leader when it comes to endpoint protection platforms. Much like S&P Global, CrowdStrike generates most of their revenue from subscriptions. It has consistently seen strong double-digit revenue growth fueled by rising cybersecurity threats and increased cloud adoption. Once a customer signs up for the services, they tend to stick to using them. CrowdStrike consistently enjoys a gross retention rate that is well over 120% over the long term. One of their biggest growth drivers is its ability to cross-sell additional security modules to existing customers. Over the years, the percentage of its customers signing up to 5 or more modules have been steadily going up. And thanks to its cloud-native subscription-based model, CrowdStrike is a highly profitable company that enjoys strong gross margins. Now, even though they had that global outage last year, they have not only managed to avoid many customers cancelling subscriptions. Instead, their revenue has continued to grow strongly. That just demonstrates how strong the moat is, where due to its strong brand loyalty, high switching costs, network effect, customers are willing to stick to them even after the hiccup. And as more and more businesses shift to cloud-based security solutions, demand for CrowdStrike's platform will just continue to grow, giving them the tailwind to fuel their long-term expansion. As for the valuation, Morningstar put its fair value at $300, making it overvalued by 30%. By now, you should have a rough idea of what makes a good company. Basically, they should have strong predictable growth, high profitability, have a strong moat, or while having a strong tailwind that will fuel its growth for years to come. So another one of such examples is Palantir. Now, I'm sure most of you are already familiar with what this company does. But for those who don't, Palantir is essentially a company that helps governments and companies make sense of massive and complex data sets. For example, the US Department of Defense uses Palantir's software to track enemy movements, detect threats in real time, and support military operations. And in the healthcare sector, Palantir was used by the National Health Department to track COVID-19 cases, distribute vaccines efficiently, and optimize hospital resources. Now, in the past, one of Palantir's biggest concerns was that whether they could successfully expand beyond their core government business into the commercial sector, because while its government revenue is stable and recurring, realistically, there's only so many contracts that are available in the government sector. But as time goes by, Palantir has successfully shown that there is demand for them in the commercial sector. In fact, in the last few quarters, their commercial revenue has been growing faster than government revenue. Palantir displays many of the same characteristics as a successful subscription-based software company. Its revenue is highly recurring and is steadily growing. It has a sticky customer base, which contributes to the high net dollar retention rates, and it is a highly profitable business with gross margin of around 80%. In fact, Palantir's growth right now is so absurd that they are scoring 81% in the Rule of 40. Rule of 40 is a principle that states that in order for a software company to be considered successful, their combined revenue growth rates and profit margin should equal or exceed 40%. But here, Palantir is doing 80%, which means the company is currently experiencing a boom phase. Personally, I have no doubts that Palantir will continue to do well, given that there are very few companies in the world that are able to do what Palantir is able to do. They are the one of only 3 companies that has the highest security clearance for the government sector. There's a high degree of trust in the company. They are powered by AI-driven intelligence, deep integration, and they have a high switching cost. However, with that being said, the problem with the company right now is that it's a little overvalued now. Morningstar gave this company a $90 fair value rating, which makes it overvalued by around 20%. Next up, we have Google. I believe this is a company that needs no introduction. Many of us use Google's products on a day-to-day basis, whether it's Google Search, Gmail, YouTube, and so on. And when we think of Google, we think of them as a dominant leader in the search industry. So much so that when ChatGPT and all the AI chatbots came out, everyone was worried that Google's search business would finally be taken away. In fact, Wall Street Journal recently came out with an article which says that Google's grip on search slips as TikTok and AI startup mount challenge. But interestingly, when we look at the financials itself, it is painting an entirely different picture, and there was no hints of this search dominance going away. Their advertising revenue is still steadily growing, despite more and more LLMs appearing on the internet. And I think this chart summarizes this nicely. The web page visits per month to Google still far exceeds the visits to AI sites. Now, sure, there's no denying that the amount of traffic to AI sites has been slowly going up, but here's where all the rest of Google's revenue sources come in. Besides search advertising, Google also has a monopoly in the YouTube business. There's no other video platform like YouTube. There's Google Ads, which still remains the dominant place for businesses to advertise their stuff. Then there's Google Cloud, which even though doesn't have the biggest market share, it is slowly but surely gaining market share while having the fastest growth rates of Google's revenue sources. Then there's also the revenue from Google subscriptions, platforms, and devices. But perhaps the most exciting thing about Google is this tiny part here, which they labeled others. This includes Google's autonomous vehicle, Waymo, which has achieved 150,000 weekly paid rides and will be expanding to 10 new cities in 2025. Google's own LLM, Gemini, as well as the quantum computing chip, Willow, all of which may seem insignificant now, but will grow into a much bigger piece in the future. For now, Google displays many of the same characteristics that we have seen in the earlier companies. It has a strong predictable growth for revenue, net income, as well as free cash flow. Google has a wide moat protecting its business, whether it's their search engine dominance, network effects, ecosystem lock-in, plus the fact that they have so much cash lying around just gives them incredible strategic advantage to invest, acquire, and innovate without worrying about financial constraints. As for its fair value, Morningstar gives Google a $237 fair value as compared to its current stock price of $187, making this one of the only company in this list that's currently undervalued. Last but not least, we have Meta, or Facebook. Much like Google, Facebook is another company that is highly misunderstood. Most people still see Meta as just a social media company. That's why back in 2022, when it was reported that Facebook lost its daily active users for the first time, the stock crashed by more than 20%. This later turned out to be just a false alarm as Facebook user growth returned back to positive. Later on, when it was reported that Meta was investing billions of dollars into the metaverse, which did not show any immediate results, the stock plunged again. But if we take a step back and look at the big picture, you will see that many of these concerns are blown out of proportion. For example, while it's true that the user growth rate has been slowing down, it is actually still growing steadily. Not just that, both their advertising revenue as well as total revenue has also been increasing. But perhaps what's more impressive is that even though their ad impressions have gone down, the average price per ad has gone up. Meaning, if you are an advertiser on Facebook, you would be spending more money on Facebook ads this year as compared to last year. So, inflation is real. In fact, the average revenue per person has also gone up with a CAGR of 15.5%. Also, Meta is able to steadily reduce their expenses in relation to their revenue, while also keeping their effective tax rates low. So even though Mark Zuckerberg is throwing billions of dollars into their metaverse, their net income and earnings per share has been growing. Now, while Meta's advertising market share is not as large as Google's, the truth is that Meta isn't really competing with Google, since Google focuses on search advertising while Meta focuses on social media advertising, and both can coexist side by side, especially when advertisers want to capture the entire pie. Now, will the metaverse investment ever turn profitable? I think history has shown that time and time again, Mark Zuckerberg is capable of making bold bets that seem crazy at the start, but eventually turns out to be a genius decision. From buying Instagram with $1 billion to buying WhatsApp with $19 billion, or even his latest bet to invest up to $65 billion into AI. And if you look back at Facebook's original 10-year roadmap, back in 2016, you will see that Mark Zuckerberg has actually planned for all this well ahead into the future. Stuff like AR, VR, and AR. So it's not as though he's just making rash decisions today. This outlines the importance of Mark Zuckerberg and a founder-led business, one that is able to take risks, experiment, and have the patience to pursue a far-reaching strategy, even when faced with skepticism. Pair that with several of Meta's competitive modes, such as social network effect, data advantage, ecosystem lock-in, and a strong brand loyalty. I believe that Meta will continue to grow far ahead into the future. As for its current valuation, well, Morningstar puts it at $770, which makes it currently undervalued when compared to its $790 current price. So those were my top 5 examples of companies that I would consider buying and holding over the long term. But do comment down below and let me know which are your top picks. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.